Hello, hello. Welcome to another episode of Financial Tides. I'm joined today again with my co-host John Perillo, certified financial planner, and we're going to be talking today about first-time home buyers and some advice that we have for a first-time home buyers to make the process smooth and successful.
Hello, everybody. Good to be here. Thank you for your time today. So, our discussion points are, be sure you're ready to commit to a loan for a first-time home buyer. It's a big move, and there's 15-year mortgages, there's 30-year mortgages, there's a lot of different variations out there. But what you really need to do is ask yourself three key questions. Am I going to commit to this home and this city for at least 5 years? You'll see in a little while, there's a lot of closing costs. It doesn't make sense to buy a home and then a year later move. So it's real easy if you're a firefighter and a teacher. You know you're going to be there 30 years with pensions from those cities. But it gets a little trickier if you're that high-flying executive. And we know things happen. You buy in. If you have to move a year later, maybe that's part of your package from your employer. But try to make sure that you're going to commit to the home for at least 5 years. And make sure you have an emergency fund to cover 6 months of expenses. And that applies whether you're renting or buying. And then make sure you have a stable income, obviously, and the bank's going to make sure of that. You're not going to get the loan if you don't have a stable income. And if the answer to any of these questions is no, you should probably rethink whether you should be buying at this juncture in time.
And I think just piggybacking onto the emergency fund part of that, it's not an emergency fund to cover 6 months of expenses of your current expenses when you're ready to dive into buying a home. It's 6 months of expenses after you take on that mortgage. So that's kind of a big kind of distinguishment that people will say, oh, well, I'm doing great. I have 6 months of my expenses, and they forget that the mortgage is more expensive than what their rent would have been, and they really need to have a larger emergency fund as a result of that. So, and I think the other big thing is it's really tempting to really jump right in to house hunting and try to find the perfect house, try to find a house you can grow into. It has all the features you want, and obviously it's not going to be a mansion or anything with your first home unless you really did well straight out of the gate. But I think it's really kind of a good idea to be prepared to settle on quite a few things and get a home that you can start working with. You can make improvements along the way in, but is very much within your means instead of kind of stretching your budget at the beginning, which really leads to the 2 points of knowing the difference between a pre-qualification and a pre-approval. So this is kind of going to tell you, and this transitions nicely because it tells you what you can actually afford. So the pre-qualifications first, which is basically just kind of a rough estimate, very limited documentation needed of a home loan that you can get. And you'll typically get that before you start looking for houses to kind of get an idea with your realtor what houses are going to look like and what the top end of your budget might look like. Whereas a pre-approval is a document from the actual lender that states you will be approved for this much based on the information that you've given us, and you're pre-approved to get a loan at that amount if you find the property. So a little bit different between pre-qualification and pre-approval. And then basically there's some reasons why you'll want the actual pre-approval once you get a little deeper into the process. So we typically suggest get the pre-qualification letter before you start looking at homes, before you start working with a real estate agent, so you kind of have an idea of where you should be looking. And then when you start narrowing in on exactly what you want, that's when you want to get the pre-approval letter so that you can actually know exactly what your purchasing power is. You have the letter in hand and you're ready to make an offer based on exactly what you're pre-approved for.
Great. And, this is probably a good time to talk about credit ratings. And there's a commercial out there that runs all the time about free annual credit report. That's actually not the one you want, because and Josh is going to put the one up I'm going to tell you about in a second. He's going to put it up at the end or somewhere in this podcast. But the one that they advertise, free annual credit report or free annual report, you get your number and it says, oh, you're a 720. And then it says, for 1995 or 49.95, we'll give you the details. So it's not a scam. It gives you your number, but the one you want is called annualcreditreport.com. And that one you only get once a year for free, but it gives you not only a score, it gives you, the all the three main TransUnion and all the three vendors that provide data. So you'll see when you get that. It's definitely worth getting because you'll see open credit cards that are on there that you don't use anymore that you can close out. So maintaining your credit's key. And bankers are going to really scrutinize these days. There was a mortgage I got in '07 where all you had to do was fog a mirror to get the mortgage. And then the last mortgage I got, they put me through the ringer. They were questioning $11 Ubers on my credit card, they really weren't questioning those, but you know what I mean? They were going over the top. So a lot of times I'll talk to a first time buyer and they'll say, well, the loan to my parents will be paid off in 6 months so I can afford that mortgage. And they're making an auto pay of $1,000 to their parents. I'll say, if you're going to apply for a mortgage in 60 days, you need to stop that auto pay to your parents now because and make a side deal with them because they're going to look at that and say, hey, you got another encumbrance here. That's officially a loan, or pay it off in a lump sum to your parents and then start fresh with the new mortgage company. So you want to make sure your credit's in good order and you want to understand your loan options. And I think the most important thing to understanding your options is getting a good broker and then getting a second opinion. And we get calls all the time from children and grandchildren or clients that are first time buyers that say, my dad wanted me to run this by you. And we can give them a second opinion on it in case they weren't confident or didn't understand what the broker said. But most of the times the broker will say, the FHA loan is not for you, and this one is for you. And they'll be able to narrow it down so you're not trying to figure out which of the 10 options are available. And I'll go through those very quickly now. There's conventional loans, the 15 and 30 year. And the down payments on these houses are 3 to 20%. And if you don't have 20% down, you're going to have PMI or MPI. It's called mortgage protection insurance. It's an extra monthly fee tacked onto the mortgage payment every month because you don't have enough equity in the house and you're additional risk to the bank of default because there's nothing for you to walk away from because your equity is so low. So if you do wind up with PMI, you can get that removed later on when your equity threshold hits 20%. And there's people on this call who have done it on on this video that is speaking to you. So back in the day. Then there's the FHA, Federal Housing Administration loan. There's and these can be low down payment loans as well. There's a USDA, Department of Agriculture loan. And again, I don't want to spend all the time on these. The mortgage broker will tell you whether or not you're even eligible for that, and so you don't have to understand it. But again, finding that right mortgage broker is good. And if you're a veteran, there's VA loans, and they never worked out for me. Every time I went to mortgage, the VA loan was not as attractive as my own strong credit rating and my earning power and the ability to get my own loan direct with 20% down, except for my first one. So,
Yeah.
well, anyway, those are the gist of it. And then we'll talk a little bit about rates and fees.
Yeah, and I think that's the big point is what you just said with the VA loan is that certain mortgage rates and types are different from loan to loan. And there's a lot of different products out there, whether it be variable rate loans and just some of the other ones you mentioned. So I think it's really important to shop around and just see what's out there, what you qualify, and don't be set on just one mortgage type. I hear a lot of times people saying, I want an FHA loan because I'll only have to put 3.5% down. And they forget that most conventional mortgages actually switch now to low down payments as well. And then they say, well, I want to avoid the PMI, but FHA loans it's not called PMI, but they have their own insurance because it's backed by the Federal Housing Association. So just make sure you look around, you see the different types, see what the rates are, see what the fees are, and find what makes the most sense for you, not just what you've heard about the most on social media or what a friend told you they did. So just make sure you're checking everything out. And then I think the next thing is really just saving for a down payment. I see all too often people will go on and on with high rent prices, living in a high-end apartment complex and trying to save for their first house, and they're not realizing that they're not really making a lot of progress. And I think one of the big first things to do if you're trying to save for a down payment for a house is to try to cut your rent expense, pay off your car, pay off a lot of your other debts so you're not paying off all those monthly payments at once, and then getting it all together, all those funds together that you were paying on high rent and debt and car payments, and put it together as a down payment fund along with some of the other savings, and try to get to that 20% mark. Again, you don't need that 20%. You can get rid of that PMI sooner rather than later if your house appreciates or you can make extra principal payments. But I would say you definitely want to have a strong down payment and you want to have it sitting in your bank account, because if you do not have it sitting in your account, the bank is going to ask for a lot more information about where the funds are, where it's coming from. And if it just hits the account, the funds won't be deemed seasoned yet. So they have to be in the account for 60 days. And then the next portion is qualifying as a first-time home buyer. There's also some assistance programs. I know California right now is doing a joint equity venture. It's kind of by a lottery system right now, but basically they'll put the 20% down for you and they'll own 20% of whatever the equity is in your home until you pay them back or sell the house. There's other options as well for like VA loans with 0% down, just to kind of consider and be aware of what some of your options are that are out there if you haven't saved for the down payment yet. And then, John, do you want to kind of jump in for closing costs?
Sure, and closing costs they've gotten trickier now. So a lot of times closing costs, as expensive as they can be, 5% or more of your 2 to 5% of your loan. For years, people would pay them or roll them into their mortgage. So you can roll them in. So if you're buying a $500,000 home and you've got 10,000 in closing costs, maybe your mortgage is going to be $10,000 bigger. That was okay when rates were at 3%, because now you're paying that $10,000 at 3% over 30 years or 15 years. But rates are higher now at 7%. So if you're going to finance those closing costs, you're going to be paying a lot of that. $10,000 is going to cost you $30,000 over 30 years. So think twice about financing those. That might be something you want to pay. And then closing costs are very, very specific. There's a disclosure. It's called the closing disclosure. And you'll see on there, FedEx, FedEx number 2, FedEx number 3, title search, blah, 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 the signature, notary, and they itemize everything. So now you've got a long legal sheet with 100 costs. Whereas I remember like one of my first loans 30 years ago, there were like 3 closing costs on there or 4 closing costs, but it was no longer acceptable, I guess, in regulation to have title company $3,000. It had to be broken down, title search fee, whoever the title company had to pay out from the closing, all those different fees and FedExes. So it's a little more detailed now. And then, as a first-time buyer, you may qualify for government backed grants or loans that assist with closing costs. And it's also common to ask the seller to help cover closing costs. These are called seller concessions, where you go back and say, will you pick up part of the closing cost? And sometimes the realtor comes back and says, the seller is firm on this price, but he'll pick up part of the closing cost if you agree to this price. And maybe he wants that higher price for whatever reason. He's got a capital gain step up and he's not worried about it. And so, and the concession on cost may work out different for him. So always consider asking for concessions.
Yeah, and I think that's the big point of why you need to find a good real estate agent as well. Obviously, first-time home buyer, you're very new to this process. Most real estate agents have done it hundreds of times, and there's some really great ones, I'm sure, in your local area, and there's some great ones in our local area here. So I think finding somebody that's going to go above and beyond and scour the market and even look into some things that you may not have thought you might be interested in at the beginning, but can really help you and kind of frame some of those trade-offs that you might have to make along the way. I think it's really important to have a guide and an expert that's going to be able to point you in the right direction and kind of help you through the process and do some of those things like suggest, hey, we can get creative with the offer and ask for seller concessions here or work a deal a little bit differently. And I think that's where the experience comes in of doing multiple deals really helps having that person in your corner, because there's probably ways that they've thought of or structured a deal that you never even could have fathomed being an option for yourself. So I think having that option, talk to a couple agents. I know everyone probably has a friend that's in the real estate business. Talk to them, and maybe a couple others, and just make sure you find somebody that's a good fit for you and that you're going to be comfortable with going property to property for some time until you find the house that is the right starter house for yourself. And I think that's really the last point for today. So buying a house is really a huge and exciting process, and it's a big purchase. And we want to be here to help arm you with the facts. We're another expert in your corner, in addition to the loan officer, in addition to the real estate agent. It's a big process, and there's a lot of stuff that goes into it. So we want to make sure that you're confident in your decision and that fits in your financial plan. So if you have any questions or anyone that you feel this might be pertinent to, please share it with them, and we are happy to have conversations to help you make this decision a great one. Thanks so much for joining Financial Tides. We'll see you next time.
Thanks, Taylor. Thanks, everyone.
John Perillo and Taylor Perillo are financial advisors offering securities through Cetera Advisors LLC, a registered broker-dealer, doing insurance business in California as CFGA Insurance Agency LLC, member FINRA/SIPC. Advisory services offered through Cetera Investment Advisors LLC, a registered investment advisor. Cetera firms are under separate ownerships from any other named entity. California insurance licenses number 0F60123 and 0M90666, 6265 Greenwich Drive, Suite 251, San Diego, California 92122. The views depicted in this material are for information purposes only and are not necessarily those of Cetera Advisors LLC. They should not be considered specific advice or recommendations for any individual. Neither Cetera Advisors LLC nor any of its representatives may give legal or tax advice.